Hello and welcome to PQ Prime. I'm Hiral Dadia. One stock that is in focus in today's session is TeamLease, which is one of the leading providers of human resource services in the organized segment with almost a 6% market share in flexi staffing. To decode the earnings, joining us on the show today is Ramani Dathi, Chief Financial Officer at TeamLease Services. Ramani, welcome to the show.
Thank you. Yes.
My first question coming to you is overall, do you think the numbers have met your internal expectations? Ramani, are you able to hear me?
Just last 5 seconds, I didn't get it. So the
So
overall hiring, yeah.
Yeah, I'm saying overall, have the numbers met your internal expectations?
Not at all, because typically for us, Q3 contributes the highest headcount on back of the festive season that we have in October, November. And this is the first time where our Q3 headcount addition is lower than Q2. So this is also, kind of in line with the kind of numbers which the other retail and FMCG companies have published as a weaker festive season. So coupled with these segments in IT, right now there is a complete hiring freeze. So last 2 years, we had a phenomenal growth in IT staffing, 30-35% growth. But however, starting Q2, we are seeing a hiring freeze across all IT companies, products and captives. And also in Q3, specific to Q3 in IT. So there are and many IT companies enforce leaves in the month of December. So that also has impacted our billings and margins in this quarter. And more importantly, the biggest surprise to us is government discontinuing the NEEM program, which is meant for apprentices. So as of December, we have to release close to 20,000 apprentices. And we have another 26,000 apprentices continuing on the program. So there is uncertainty around that. We are working with the government. We are also filing other petitions and kind of evaluating the legal options. But this came out completely out of surprise to us. Yes.
Right. So overall, as you mentioned about the NEEM program that has been discontinued, and I think it's effective 23rd of December, right? 19,000 trainees, as you said, who were under the short-term training program you've released, and another 26,000. What's the overall impact in terms of business that we see out of this?
Yeah. So for the 20,000 that we have already released, in terms of our markup, they contribute close to 22 crore in markup, and the net profit contribution is about 10 crore. So that's something which has already hit our bottom line and will start reflecting from Q4 onwards. Q3, the impact is not shown because the release has happened as of 31st December. However, for the balance 26,000, we are evaluating the alternative transition options, like how many of them can we move to the NAPS Act and how many of them can we convert into staffing roles so that at least we retain the headcount in one of our business lines. So those discussions are happening. So at this point in time, out of 26,000, we believe that we should be able to retain at least 70-75% of them in some form or the other. And maybe 20-25% could be at risk.
Right. Already all of that. Now, in terms of the DA program that you have as well, any future additions that do come in, how are we well equipped to actually absorb them under the company's DA program? So, what's the strategy going to be on that end?
Yes. So we have 3 categories for enrolling apprentices under our DA business vertical. So one is under the NEEM program. So as I mentioned, as of now, we have 26,000 trainees. And in addition to that, we have close to another 35,000 trainees who are under 2 categories, which we call it as client quota and TeamLease quota. Because every company can keep at least 15% of their employee base as apprentices. So there is that quota available. And also TeamLease, because of our staffing business where we have close to 2.5 lakh employees, on that base also we can avail this 15% quota. So between these two, we still have a large pipeline available. We can hire and add more trainees under these 2 buckets. So that's where I'm coming from, saying that even this 26,000 also we can transition to those options.
Right. Overall, from a sectoral perspective, you already mentioned the kind of freeze that we've seen in terms of IT as a sector, right? Apart from that, what are the kind of trends that you've been seeing across various segments? Because on a sequential basis, also we are seeing a decline in terms of hiring.
Yes. So it's not like all industries and verticals have completely slowed down. Banking, financial services, insurance, they're still hiring well. To some extent, consumer companies are also doing very well. Where we are seeing kind of slowdown in overall hiring is definitely the private equity funded startups, the edtechs, fintechs. So those segments we have seen a complete slowdown. Manufacturing, industrial, we have expected a higher momentum, but looks like it's going to take a little longer. But we are bullish about the long-term hiring trends that would come up in manufacturing and industrial. So telecom, as of now, for Q4 and coming quarters, we have good outlook and pipeline. And we believe that these segments will continue to contribute, BFSI, consumer, telecom, those segments. However, the startups, private equity funded tech companies, and IT services and captive companies, they'll continue with the slower hiring trend for a while.
Right. And overall, from the different business segments that TeamLease has as well, how are you seeing the performance? Because overall, even HR, that side of it has seen a decline. So, I mean, is there a bounce back that is expected soon? And how is that trend visibility for you?
Yeah. So firstly, since we have a very well-diversified portfolio, irrespective of the slowness in the market and the overall outlook, we can still get to 20-22% of top line growth even for the current year on a full year basis. However, on profits, we'll be flattish. We'll be doing same as last year. So even for next year also, we are saying 20% top line growth is still guaranteed. If the market recovery happens, we can target higher than 25%. And coming to specifically on HR services, so this is more of a deferment in revenue billing for the universities. And we have indicated that on a full year basis, we'll still get to 8% margins, EBITDA margins under our HR services by end of Q4. So that business is on track. So we are not having any kind of headwinds under HR services. And year-on-year growth is also higher than 30-35% since the base itself is small in HR services. So that trend will continue.
Right. And overall, in terms of the specialized staffing services as well, the margins have, dipped substantially. So are we expecting a bounce back there? And what are the reasons why we've seen that kind of a dip?
Yeah. No, definitely there'll be a bounce back in Q4. And on full year basis, we should maintain 8.5-9% of EBITDA margins. Specific to Q3, as I mentioned earlier, so we have furloughs and lower billing days. Because many IT consultants are asked by their companies to take leaves, to avail all of their leaves before 31st December. So we get to bill for lower days in the month of December. However, the salary has to be paid for the full month. So that's the main reason for the drop in margins, but that's a one-time kind of impact. Q4 will get to our regular 8.5-9% kind of margin levels.
Right. And overall, taking the demand scenario into consideration, would it be right to say that the next 6 to 9 months is going to be challenging and we really need to be cautious? Or do you think, this is a one-off and this is going to be again an uptrend that we will see from here on?
With the kind of scenario we have seen in IT, because just within a couple of months, things have changed. Because till July, the hirings were happening and we were adding at least 200 headcount every month, new headcount in IT consultants every month. However, within couple of months, between August, September, the entire scenario has changed. So, I cannot put down a timeline saying that whether it will take 6 months, 9 months, 12 months. So if the recovery happens, then it can happen quickly as well, maybe next 2 or 3 months. Because going by the results that the IT companies have published so far, mandates and new orders, and they cannot continue with the hiring freeze for a long time, because for them to execute those orders, they need to hire people. And given the uncertainty, instead of hiring permanent employees on their roles, they may prefer going with contract employees because that gives them the variability of playing around the headcounts and cost structures, all of those elements. But having said that, as of now, there are no green shoots, whether those things are happening on ground or not. And we think that at least 1 or 2 quarters, this kind of slowness will continue.
Right. So overall, what will be the de-risking strategy for the company, taking into consideration what's happening with IT as a space?
Yeah. So now what we are doing is, since the IT services companies have this hiring freeze, we are focusing more of tech hiring in non-IT companies, because be it engineering companies, manufacturing companies, so now service companies, now all the companies are setting a large internal IT teams for their transformation, digitization projects, all of those. Post-COVID, those investments have gone up. And that we are kind of seeing a huge demand coming up. And in fact, we had a slight growth in Q3 in terms of headcount by the end of quarter. So the full impact will show up in Q4. So around 250 new associates have been added in specialized staffing. So these are the IT resources whom we hired for non-IT companies, mainly the engineering companies and other industrial companies. So that's one element which we are using to de-risk. The second one is we have brought down our backend costs substantially. So that's why we are saying by Q4, we should be able to bounce back to the margins of 8.5-9%. So we brought down close to 100 headcount in our backend internal teams, be it recruiters, service delivery, account managers. So given the current outlook. And however, in our general staffing business, as I mentioned earlier, because of the diversity of industries that we cater to, 20-22% of growth is something that we are assured of.
Right. And very lastly, overall, with regards to shareholder value creation as well, we have a buyback meeting, which is on the 3rd of Feb, right? So I think the reason why we are doing this is also because we're expecting a refund of around 80 crores from the income tax department, out of which 21 crores is already in. What's the rationale for the buyback versus a dividend payout?
Yeah, so since the meeting is scheduled on 3rd Feb, I can't disclose much now because the board has to take it up for discussion. But however, there are few call-outs that I can make. So we haven't done any M&A acquisition in the last 3.5 years. And right now, we don't have any other active pipeline as well in terms of inorganic investments. All of our existing businesses are asset-light businesses, so they don't need any heavy investments in terms of CapEx and others. And since we have close to 350 crore of cash balances, free cash balances, that is estimated by end of Q4. So the board is evaluating how should we plan about capital allocation and what are the alternate options that we can take. So to the specific question in terms of dividend versus buyback, I think after 3rd Feb, we can get back to you with the concrete explanation on that.
Absolutely. Thank you, Ramani, so much for joining us on the show. And thank you for that candid conversation as well. Gives us a lot of perspective of not only what's happening with the company, but what's the scenario looking like from a demand, supply, as well as, from a sentiment perspective across sectors. Thank you. Stay safe and speak to you soon again.
Thank you so much. Pleasure.